I appreciate it, and I appreciate everybody taking the time to get on this afternoon. And it's we're switching gears a little bit, but the previous speaker, Hubert, did a great job. I was listening to him for the last 15 or so minutes on technical analysis and how he utilizes it and going over the various markets. It's very engaging. Raleigh, thank you for the invite. Yana, Morgan, it's great to be here with TradingPub. I'd also like to say that this is a co-sponsored event as well as with our partner Tradespoon. And Vlad Karpel is going to jump on when we have some time after today's presentation. But my name is Joe Cusick. I am with MoneyBlock and TradingBlock. We're a broker-dealer that's for self-directed traders as well as advisors. And today I want to talk about option spreads, trading for profit or probability of profit. I think it's an interesting concept and way to discuss trading strategies. It's the way that I've been talking about it for almost the last half decade, and it's obviously gains a ton of traction within the community. Before I get started, I do have to go over some disclaimers because I am a registered rep at a broker-dealer, and there's two things. One is that I, again, want to thank Vlad Karpel and his team being part of this. So Vlad Karpela is Tradespoon founder and is an employee of AOS, which does business as TradingBlock and MoneyBlock, a registered broker-dealer, FINRA, NFA, and SIPC member, and a registered investment advisor. Tradespoon and AOS are not affiliated companies, and the content contained in Tradespoon is not endorsed by AOS. AOS has advertising and marketing arrangements with parties and that are not registered or regulated broker-dealers, such as Tradespoon. And as part of these arrangements, AOS pays fees and provides other forms of compensation in exchange for marketing. Options do involve risk, folks. May not be suitable for all of us. Please read the characteristics and risks of standardized options. Go to the optionsclearingcorp.com, or you can come to MoneyBlock or TradingBlock.com. Also, any stock, option, or future symbol that I'm talking about today is for illustrative purposes only and should not be construed as a recommendation to buy, sell, or hold any particular security. All right, let's get started. And if there's any questions or considerations, unfortunately, I'm not able to see these right now because of the sharing mode I'm in. So hopefully this is being projected. If Yana and Raleigh, if you see anything or see any questions that are coming up, just pipe in, and if there's any issues, otherwise I'll get to those when we get to the Q&A section. But before I get started about jumping into the exact strategies, I want to define for you, first of all, profitability and probability in my terms. Profitability in my world is defined as break even or better. When you're trading options, if the conservation of capital is something that's paramount. Probability, well, in my world, the probability for a trade to achieve break even or better. That's how I use probabilities as part of the process of picking a trade. Now, Hubert was talking in the previous example about utilizing technical analysis as entry and exit points. I believe in using technical analysis to get a perspective and a point of view. And as far as making entry and exit signs, you can build out some proprietary technology. But for me, technical analysis doesn't have that forward-looking component that is built into options. And that's why looking at options can actually enhance that technical analysis perspective. And so that's what we're going to touch on today. And we're going to look at a mixture between looking at trades that could have a higher profit capability, or do we go with the higher probability? Okay, and the four strategies that we want to take a look at today and over a limited period of time. So I apologize if I go a little bit fast, but the good thing is that this is actually recorded, is we're going to look at the bear call spread, the bull put spread, the bull call spread, and the bear put spread. So let's get started. We're going to look at the long bull call spread. Now, for those of you that have never traded this strategy, you're going to get a little bit of education here, but this is also going to show you how you can actually trade strategies, and instead of getting in and out after losing $100 or $150, which might be a little bit frustrating for some of us as traders, two things that you can do when you utilize options and specifically spreads. One is that you can actually pick a longer time frame. Two is that you can define your risk so that you don't have to have pinpointed entry and exit points, but that you can actually sit through times of volatility, uncertainty, or when an actual position is going against you. And you can structure the position so that in spite of the fact that the stock might be working against you or the underlying might be working against you, you have time on your side and you've mitigated some of that risk as far as the position. Now, the stock I'm looking at was trading at 82.23 when I was looking at it. That's that red arrow right here. Now, what strike price would you pick if you see that the stock was trading at 82.23 at this point? Well, you can see the stock has pulled that back subsequently. And I actually baited Hubert a little bit, and he actually gave me some insights on this stock. This is actually Course. Course has pulled back since I looked at this in July. Over the last 4 weeks after earnings, it pulled back. It was in the 90s, then it came down to the 80s. After earnings, it came down to the mid 80s, and now is down in the upper 70s. So it's pulled back pretty considerably since the earnings were announced a few weeks ago. So the question I ask all of you when you think about this back in July was, if you look at the stock, at the strike price, at the premium on the options, specifically the call options, because we're looking at a long call spread. And what is a long call spread? It's buying one call here and selling a call above it. That's a long call spread. Now, when you look at these prices, the $75 calls, which were in the money, we're trading for around $9. The 80 calls around $6. The 85s at 3 and some change, and then the 90s, they're right around that 190 level. Most of us would look at this and go, well, I want to put this minimum amount of capital at risk as possible. So I'd look at the $90 calls. Then I'd switch gears, because this is why most of you that have traded options have not had much success. Because if you look over at the probabilities, whether it's expiring above, below, or touching, you'd see that the probability of the $90 calls expiring in the money at expiration was only 27%. Right off the bat, you basically have a 73% probability that these things are going to be worthless at expiration. Now, just seeing that 4 weeks ago would probably have been enough to deter you from buying those $90 calls. But if you look at the the $75 calls, you'd see that the probability of those expiring in the money is 67.5%, almost 68%. Now, what would dissuade you from doing the $75 calls is paying the $9.80. That's a pretty hefty premium. So what could you have done? Well, first and foremost, what we do before we even go any further is that we either look at it individually, or we can just pick price points of whether or not the probability of an underlying being at above or below a certain price level. Now, I'm looking at this level right here, these two levels, 76 and 79. These are basically being run at around August expiration, which is at the end of the week. So as a matter of fact, for Course, KORS, there's a 40% probability that the stock will be above 79.82 expiration. There's also a 46% probability that it will settle below, at the end of this week, 76.26. You can mark that down. That's basically one standard deviation out of the money for both the upside and the downside. So it's real interesting, folks, and you might want to mark that down. See how that actually works out for the rest of the week. But again, let's look at the profitability of these and some strategic approaches that we can look at. One of the most conservative approaches that you can take with this, and this is what we looked at 4 weeks ago, which was buying the $75 calls and selling the $90 calls. This is a 15-point call spread. I paid $9.80 for the 75s, and I collect $195 for the selling the 90s. So that's a bull call spread. It's in the money. You see I have limited risk and I have limited reward. You see also too, with the stock trading around 86.20, I think, or 82.23, that the break-even point is at 82.85. So I didn't have a huge threshold to get to break even. And remember, one measure of success for me is profitability. And if I can get to break even or better, that is telling me that I'm conserving capital. That means that I will be a more profitable trader than someone that looks at something like, let's say, for example, the $85-$90 call spread. Now, the $85-$90 call spread, I'm buying the 85s and I'm selling the 90s. You can see that the next cash outlay is $180 versus $785. So it's significantly less cash. But there's two things that I want to look at. One is that the break-even point for this spread is at 86.80. That's basically almost $4 higher than the break-even point for the 75.90. Okay. The other thing that I want to look at here too is that this is a 5-point spread. So you're also seeing the risk reward. I'm risking basically 1 to make about 2. It's about 1.5 to 2. Here, I'm basically 1 to 1. So I'm not seeing a much better risk reward from a capital perspective. So what's going to be the deal breaker? What's going to be the thing that is going to help me determine what would be the more optimal type of strategy, especially if I say I saw a signal from Hubert's program, which basically told me, or I went to Tradespoon and I looked at the probability calculator. What if it told me that maybe it was a mixed market, that it was neutral to maybe coming off of a bullish move? Look at the probabilities. Specifically, again, the probabilities of being expiring and touching certain levels. And the reason why I'm highlighting touching here is because if there's a high probability of touching certain levels, that could be a point where you could take off that particular strategy, right, for a profit. Now, I apologize. I don't know why this, I thought I changed this. I must not have changed it. The probability of it touching, and I'm going to go back here a little bit. The probability of it touching the $90 level is right about 60%. Okay, so if I'm selling those $90 calls, there's a 60% probability that's going to potentially touch that level between now and September expiration. Now, again, I was looking at this in the middle of July, so that basically was a little over 60 days. Now, the probability of it touching 85 was about 84%. So I know that at some point in time, I could have a pretty decent opportunity to potentially take profits between now and expiration at 85 or 90. Okay. Now, 85, now the probability of it being below my strike prices, in other words, 80 and 75, that's my long strike, is 53% for 80 and 67% for the 75s. And as a matter of fact, you've seen that the stock has pulled back pretty dramatically. It's in that 78, 79 level. But the one point that I want to make about this strategy is that first and foremost, the probabilities are basically telling me right now. The trend of the market is telling me right now. And the time frame that I chose, the September expiration with having more than 45 days till expiration, it's telling me right now that if I want to take the most highly probabilistic trade, I'm looking at the 75.90. And the reason why is that even though the stock has pulled back from 82 down to about 78, 79 range, I still have 35 days until this expires. This gives me a lot of time to get to that break-even point of 82, 85, which basically will define me as being at break-even, which to me is profitable. There's a bigger threshold at this where the stock is trading at 79 to get over, to get back up into that 86 level over the next 35 days. So that is why, from a both risk reward and from a probability perspective, I would be looking at the 75.90. Also, another thing that I want to point out is why I would look at the 75.90. The 75.90 spread basically has around a 62% probability of being at least profitable, somewhat profitable, or break even at expiration. The 85.90 has less than a 50% probability. It had right around a 40, I think it was around a 46% probability of being potentially profitable at expiration. To me, folks, anything below 50%, especially with when I'm doing spreads, isn't a good opportunity. Now, taking a look and switching gears at a long bear put spread. Again, this is a debit strategy, so when you hear long or debit, that means that whatever you pay for that strategy is what your risk is. This stock was trading at 43.18 when I was looking at it. This is actually RIG, R-I-G. It has pulled back over the last 4 weeks. And with looking at a bearish strategy back in July, I want to first of all think about what the strike setup would be here. Well, the stock has been in a range basically between 40 and 45 for a good part of the month of July, June, July, and then going into August. So right now, looking at that, your strike selection, really you'd have a hard time trying to choose it from this chart. But what the one thing you do know is, or you see from that is that the stock had been in a consolidation. It's been pretty located in that 40-45 level. So I'm going to look probably around that price range. So what strike price would you pick? We all typically will just go look at the option prices. If you look at the $40 puts right now with the stock trading, again, I think it was at 43.18. The $40 puts, they look real attractive. You probably could pick those up for 60 or 70 cents. That's not a lot of capital outlay for one contract. But there is risk associated with that. If you look at the $46 puts, those are deeper in the money, almost by $3. You have to probably outlay about $4. So you're looking at $70 versus $400. But again, I don't get blinded by the capital component of this right away. I want to look at the probability of expiring above, below, or touching a certain level. And when you're thinking about puts, and specifically bear put spreads, the one thing that I want to do is look at, first of all, the probability of expiring below, right, and touching. This is a bearish strategy. So if the market goes down, that's going to be positive for this particular strategy. And the bottom line is that I'm going to look at strike prices that have somewhere between a 30 and 20 and 30% probability of expiring below. So you're looking in that 40-41 level. And I'm going to look at strikes to buy somewhere between the 70 to 60% level as far as probability of expiring above. Okay, so in this case, this has about a 67%, and this has around a 74%. The reason why I say that is because the expiring above is only 33%. That means that it has a 70, basically here you see a 66% probability of expiring below 45 and a 73% probability of expiring below 46. To me, these are the strike levels that I'm going to look at. Now I have to determine the width as well as the strike levels, but I'm going to look at it in terms of profitability. Why do I look at it in terms of profitability, especially with spreads? Well, because sometimes we get blinded. If we look at the out-of-the-money put spread, in other words, buying the 41s and selling the 40 puts, I only have to do a cash outlay of $38. That's not a lot of cash outlay per contract. As a matter of fact, I have almost a 1 to 2 risk rates, 1 to 1, a little over 1.5 risk reward ratio. Okay, so it's basically you're risking 1 to almost make 2, and from that respect, people get a little blinded. Why? Well, because they go, well, it's such a minimal amount of capital, I can get in and out of this. But the point being is that sometimes we don't size correctly. Typically with this strategy, this 1-point spread that you're buying for 38 cents, you're going to go in and instead of putting 1 contract on or 2 or 3, you're going to put 10 or 20. If I look at the deeper in the money contract, right, I'm going to look at this and I'm going to go, all right, well, my break even here for the 1 point is 40.62. For this, it's 42.47. Now, I do have to put out a bit more capital when I buy the $46 puts and sell the 40s. I have to put out 353. Immediately, you'll go, you know what? I don't like this trade. It's too much money. All right. I don't stop there because 2 things. One is my threshold to get to break even is much lower. In other words, I only have to go to 42.47 versus 40.62. And I'm looking at basically my risk reward and I'm going, but yeah, gosh, I'm basically less than 1 to 1. So I'm basically, I'm risking 3 to make 2. That gets a little bit difficult in my mind when I look at it from straight up risk reward. But remember, don't be blinded by just break even and risk reward. Yes, it's important. Now, there's one thing that I haven't mentioned. Quite often, when you see that these in the money spreads, these, for example, the 46-40 put spread, quite often why you see that these are spreads that you'll gravitate towards too for multiple reasons, but one of the main reasons why I'm looking at these and why these end up being the setups right now is because implied volatility in general is low. And quite often, when you see that implied volatility is real low, you're either going to be looking at doing the in-the-money spread or the in-the-money call versus the at-the-money, or in-the-money put versus the at-the-money put. In this particular case, if we had a vol spike, I would be looking at buying the in-the-money puts and selling the out-of-the-money puts. But I always go back and look at my probabilities. I look at my probabilities of expiring and touching. This is going to help me make sure that I'm going to be able to make my threshold, right? My bare minimum threshold of potential profitability, which is break even. And if I look at the put spread, the 40.41 and the 40.46, the profitability will kick in, or in other words, break even is at $40.60 for this $1 put spread, the 41.40. There is an 83% probability that it could touch that level. that means that I have an 83% probability of taking this particular position off for either slight profit, right, or break even. And I have an 81% probability of it touching 42. Now the bottom line is as you saw, Hubert actually talked about this, where it's already blown through these strike prices, but I still have time, right? And as a matter of fact, this is an opportunity where I could actually pull either one of these strategies off, and I could take them off for a profit. As a matter of fact, each one of these I could take off for I believe almost around a 40 or 50% profit, which is usually that mark that I like to take profits, by the way. Um, the thing also that you want to understand is that even though the fact that the particular stock right now is trading below these strike prices of 41 and 40, there still is about right now, there's still about a 40% probability that it could get above. It's actually a little bit less than that. It's around 30% probability that it could be above either one of these short strike prices. So you want to keep an eye on that. You want to watch for a bounce. You want to see any kind of reaction because we do have time. So that's why also, as far as another maintenance kind of point, I want to make sure that you understand that you could start taking profits. And typically I take profits um, on my debit strategies somewhere between the 50 and 75% level. I don't sit around and wait. And especially after a stock drops considerably over a course of a week or two or three, that's when I start taking profits if they warrant. And again, this could be one where I would pull the trigger even though the stock is still pretty far away from both short strike prices. I might pull I might pull the strategy off just to take the profits that are there at this point. So let's actually take a look now at a short, I'm sorry, this says long bear put spread. That should say short bear put spread, uh, a bear call spread. Excuse me, short bear call spread. And the stock again, and we're going to take rig. We're going to call spread. In other words, we're going to do a call credit spread. Now again, some of you who have not traded credit spreads, this is a great opportunity for you to short the market and have limited risk and a defined return. And again, it's almost impossible to go in and either just look at the option prices or without looking at the probabilities, and make a decision on what strategy you're going to do, right? If you just look at the option prices right now, with the stock trading at 43, I could take in roughly around $3 and some change on selling the $40 calls. I could take in around $2 and let's say 65 cents for selling the $41 calls. So you're starting to see that might be attractive to sell these bigger premiums. But the point being is that the probability of the 40 or 41s being in the money at expiration is around 74% for the 40s and 67% for the 41s. Now, we've seen that those probabilities have adjusted, and RIG has moved well below those strike points, but it doesn't mean that it cannot rally back. So the point being is that if I look at these probabilities, I start to look in the areas where I see a probability of it expiring below, or in other words, expiring above. I want it to be low as far as expiring above in the credit strategy area, and I want it to be high in as far as expiring below. So looking in the somewhere between the 44, and that might have been gutty back then because that's no better than a 50-50. It's around 58%. But looking in that 45 to 46 level. So looking at the 45-46 call spread, selling the 45 calls for 65 cents and buying the 46 calls for 50 cents, right, capping off my risk, I take in a 15-cent profit. Now, to be quite honest with you, I would never sell this $1 spread for 15 cents, for an example. It was just the quickest one that I could come up with. But the point being is that I would usually sell this particular strategy. If I'm doing a 1-point credit spread, I want to take in at least a third of the width of the spread. I also, the call that I'm selling, I want to that call has to have around a 60 to a 65% probability of being worthless at expiration. If I can't find a call that's going to have that kind of probability, then I'm most likely not going to sell it. because that means then that this call spread has better than a 60% probability or better than a 50% probability of being potentially in the money at expiration. Now flipping it around though and looking at the deeper in the money option, in other words, selling a $42 call and doing a little bit of a wider spread. In this case, we're going to do a 4-point spread and buying the 46. So I'm collecting $1.80 and I'm going to receive, and I'm paying 50 cents. So my net proceeds is $1.30. Well, that's a $4 spread. And if you think about that, that basically gets me right above that third of the width of the spread, right? I take in about $1.30, so that's $1.20 would be a third of the width of the spread, so it meets that. My break-even point is at 43.30. So the interesting thing is that this actually is already, break even when you think about it, because the stock actually it gives me some room. The stock's trading at 42 and some change. So as a matter of fact, if the stock sits here or goes lower, you're going to see that profitability is going to kick in, and I have upside. Now, not as much as this right here. The 45.15 is break even. But I'm looking at this and I'm going, this is interesting. But the risk reward, well, I'm basically risking one. My reward is one, and I'm risking about 1.5. Okay, a little over 1.5. Here, I'm risking, 15 I'm risking $85 to make $15. So you almost have like a 5.5 to 1. That risk reward ratio is very difficult for me. And you know what? Looking at the payoff, I don't know, because most of us won't be disciplined enough to do just 1 or 2 contracts of this of the $1 spread. We'll do 10 or 15 of them versus doing 1 or 2 contracts over here. And so if you did 10 of these, you're risking 850. If you did 2 or 3 of these, or maybe even 1, you're risking 270. But again, it's going beyond just the profitability. What's the probability of that actually happening? Well, the probability of it actually touching 92 is 90%. All right. The probability of it potentially being above 45 is around 42%. So again, I'm looking at this going, the 45-46 call spread is a decent spread in terms of probability, but the risk capital that I'm putting up, the $85, that seems a bit rich for me. The reward isn't as great if I'm risking 85 to make 15. Again, I would most likely be looking at this particular spread, the deeper in the money spread. And the one other thing that I would probably look at beyond probability is looking at implied volatility, but that's going to be built into these probability calculations. Okay, and so the point being is that right now, since I couldn't get 30 cents for this particular 1-point spread, I might look at the 4-point spread, where I'm basically risking one to make, or risking about 1.5 to make 1, because it to me has a higher probability. At this juncture, it had about a 50, yeah, it was around a 56 or almost a 60% probability of this thing expiring below that 42 strike, which is telling me that it's better than 50-50. I'm probably going to go with that because I like the risk reward versus the $1 strike. Now, finally, we're going to look at, I'm sorry, the short bull spread, and we're going to do this again with cores. So we're going to actually look at a selling a put spread or a put credit spread, or what's called a bull put spread. And this is a bullish strategy. Again, the stock was trading at 82.33 when I looked at this in July. And if you're looking at the put strike prices, again, when you look at this, selling then this is a real tough concept, by the way, for people to grasp, selling puts. A lot of people don't like doing it. The biggest reason is that they believe that it's a real volatile strategy, that it's more volatile than any other strategy out there. I wholeheartedly disagree. Selling puts is no different than doing a cover call. The risk reward is very similar. And at the end of the day, if you get a sign on a put, you own the stock outright. But again, that's for a different day, and we can teach that at another time. But I'm looking at this in terms of, you know, uh, both profitability and probability. What's the probability of this being profitable, and how do the risk and reward characteristics line up with two different strategies? Um, and can we make those assessments? Again, selling the $75 puts, it basically has around a 31% probability of working against us, or in other words, being in the money at expiration. Selling the $90 puts, well, that has a 72% probability of being in the money at expiration. Folks, just looking at this right now, you most likely would never sell the 90 puts. You would most likely not sell the 85 puts. You would look at selling the $80 puts because it's at 46, but you're more than likely looking at selling the $75 puts. You won't be blinded by the fact that, yes, I'm only receiving $1.70 versus maybe receiving $9.20 for selling the $90 puts. But the point is that I'm looking at this in terms of probability. How can I be more successful? This will help you from getting into really bad trades, okay? And it'll also make you more disciplined when the trade setup isn't there. So when I look at this and I go, okay, if I sell the $80 puts and I buy the $75 puts, well, my break even is at 76. So that's really, when you look at it, $7 lower than where the current stock is trading. All right, so that's a pretty big pull down. The other thing is that, um, and that was with the stock trading at 82. I received $3.30 and I'm risking of 113. I'm going, wow, this actually looks like it's a pretty good setup from a risk reward perspective, right? This, it's out of the money, okay? And so I'm looking at this and I'm going, I like this. I'm basically risking one to, or a little less than one. Let's say I'm risking one and a half, two, risking one to make about two and a half, almost three. All right, so it's about 2/3. So you could see that I'm risking 34% to make 66 on the risk capital I would have to put up for this particular strategy. So to me, now I'm starting to look at the other strategy, which is the deep in the money put, the big premium, selling the $90 puts for 920, right? And then buying the $75 puts for $1.70. That's my offset. Now I'm risking 750 to potentially make 750. It's a 1-for-1. And the 82.50 mark, which is basically where the stock is trading, is my break-even point. To me, I'm just looking at it from, where do I put the line in the sand for profitability? Your break-even point. All right. To me, I would be a lot more in I would side more with doing this particular strategy, the 75-80, the out of the money put spread, versus doing the in the money or even the at the money put spread, just from looking at the risk reward ratio, but more importantly, from my break even point. This is where I look, that break even point. Then I look at the probability of being below or above. Okay. The probability of it being below $80 is 39% at expiration. So in spite of the fact that the stock is trading right around 78 and some change right now, I still have 35 days left to expiration. If this stock gets up above um, $80, I could see that this 80, 85, $75 put spread, I could take that off for a pretty decent profit. As a matter of fact, if you ever trade credit spreads, one thing I can tell you is that you should be pulling off your credit spreads when you have a 50% profit after 20 days. If all of a sudden you have a credit spread where you see that you have a profit after of like 10 to 20% after about 2 to 8 days, in other words, the stock bounces up, let's say tomorrow, I put this on. Let's say I sold this spread for the $3, let's say for $1.70. Okay, if that particular spread is trading for roughly around 85 cents, I'd be pulling it off. Whether it happens over over 2 to 10 days. If over 10 to 20 days you see that you have about a 50% return, I pull it off. After about 25 days in the trade, and you see that you have a profit of anywhere from 50 to 75, even 90%, I don't care how much time's left. I am not going to sit around for that extra 10 to 30%. I'm going to pull it off for the credit spreads. All right, folks. Well, I want to thank you very much for jumping in, and I want to bring on Vlad Karpel. And if you have any questions and something comes up, I'm going to actually jump back into the actual main section so that we can actually take a look at some questions. But if you have any questions for me, you can go to support@TradingBlock or support@moneyblock.com. But I do want to bring on Vlad Karpel so that he can talk a little bit more about Tradespoon. And I want to make sure that we are seeing okay, yep. So I'm going to actually reduce this, and I'm going to turn this over to Vlad so that Tradespoon and what they have to do. All right, so thanks a lot, folks, and here's Vlad, and then we'll get to Q&A.
Thank you, Joe, for giving me the opportunity to present, and I want to thank TradingPub for hosting the event and giving us the opportunity to present. So some of the concepts that Joe has covered has been reflected in Tradespoon service. What we do at Tradespoon, we are looking for undervalued stock. We believe in value investing, and we believe in trading smarter, as Joe is pointing out. And what we're doing is basically we're trying to, based on the qualitative and quantitative analysis, we try to find the best stocks in any given sector and find which stocks are trending up or trending down. So we believe in value investing by Benjamin Graham or by other value investors proponents. And basically, if you can see, if you're a Tradespoon subscriber and you come to our site, you basically can see our top 33 stocks in the universe. And the idea is that, we're giving you tangible ideas. We're only giving you, several stocks per sector, and you can sort here by industry and see what are the best stocks in apparel sector, what is the best stock in computer or diversified industries. And we're giving you two values, long-term and short-term trend. Long-term rating is 1 through 10, where 10 we're very bullish on the stock. And short-term trend is 9, where we basically introduce quantitative model. We introduced a forward-looking prediction where the stock is going to be in the next 50 days. So if you look at Dow, and you click on analyze, this is the probability calculator that Joe has covered in our presentation. We're automatically selecting the best time horizon for the trade, and usually it's 50 days. So we're looking now into October expiration, and we're giving you the buy-sell rating. 9 means we're very bullish on the stock, and short-term trend. 9, we think that in the next 50 days, the stock is going to be higher than it is now. And we look at the probability of the different strikes, and if Dow is trading right now at $52.35, we automatically on your behalf telling you that 50 strikes at 55, you have this, if you're looking at the 36% probability of stock being higher, and if you sell the 54 call, then you're looking at the reverse 60% probability of stock being higher. So when you click on Dow, you can actually see that has been one of the recommendations that we've done back on May 20th, and you can see how the stock done since May 20th. It's been in this uptrend. And we provide you with a stock recommendation with specific entry and exit prices. We also provide you with option recommendation if you're an option trader, or option spread that Joe has covered today. We look at the volatility change, and if volatility low, we're doing the debit spreads, and the volatility today versus 52-week low is above the 50%. We have this volatility rank of above 50%, then we're selling the premium that Joe has covered in this segment. So the idea is that at Tradespoon we do a lot of homework for you. We provide you with the qualitative analysis and the quantitative analysis. We also provide you with reports that support our trading decisions, and we're giving you tangible ideas. We tell you what to trade, and we tell you when to trade, and we're automatically calculating the probabilities and selecting specific strike price to make sure we are increasing the probability of being a successful trade. So if you're in the market and you trade your own money, especially if you're doing the option trading or stock trading, we have a special offer, and I think you will receive it in the email, or if you guys can put it in the chat box. But if you go to Tradespoon deal, basically if you're in the market and you trade once a week, less frequently, then we have elite service. And elite service, we provide you with one trade recommendation a week. So if you trade once or twice a week, or if you're new to trading, elite is a great idea. It's a great service. We provide one recommendation on Sunday night, and we provide you with stock and option trades. And you can see that we've been averaging 35% return per trade. And if you trade more often, we provide you with one trade recommendation a day. And this is for somebody who's has 8 to 10 positions in their portfolio, and we've been averaging 21% return per trade. And our regular price is at $2.99 for this service, and for everybody who attended this webinar, we're providing a special deal, only $197 per quarter. That's $67 a month, and we have a special trial where you can try it for $1 first, and if after you try it for $1, and after 14 days the trial is over, you can cancel if it doesn't fit your trading style. But if it does, and you like the research that we're doing based on our qualitative and quantitative research, based on our analysis of fundamental data and technical data, then you can continue the membership at $197 and a quarter. And Joe has showed me that another thing that we're doing at Tradespoon, we're addressing the issue of what to trade. So we're looking at the value investing, we're looking at the underappreciated assets, and we're trying to figure out the intrinsic value of best stocks and giving you the list of the best stocks in any given sector. Then the second thing is we're looking at the timing. So we look at the 50 days horizon, which shows here, and based on this short-term trend, as long as the market is in bull trend, we're telling you when to trade it and assigning probabilities for successful trade. Then the third step is, once you determine what to trade and when to trade it, how do you, how much money do you allocate for any given trade? So here, if you click on the view portfolio at Tradespoon, and you can actually look at what we will do at Tradespoon, we'll automatically create a portfolio for you. We'll automatically determine what the return of your portfolio is based on the past performance. And we'll show you what the allocation of this portfolio among different sectors. We will automatically assign the stocks out of our best 50 list, top 50 list, and we will automatically determine, what is the proper quantity to buy for each of the positions and how to properly allocate. And then, as you rebalance this portfolio every week, we will tell you what which of these stocks to get out of and which one to keep in order to maintain your target return that you're looking for your portfolio. And you can assign the target portfolio, and it will actually compare between each trade how well we've done. So again, if you're trading and you want research and homework to kind of find a way to rank your portfolio, create this watch list of the best stocks or the worst stocks, and find the probability, look at the probabilities of each trade being successful, I encourage you to take us up on this offer. Go to tradespoon.com deal, and this is a great way to kind of get into trading. And at this junction, I'm going to return the mic back to Joe, and I appreciate the time and opportunity to present. And at this time, we'll address any questions you guys might have. Thank you.
Thanks, Vlad. And I'm going to jump back in. I know you're probably seeing a blank screen right now, so I'm going to jump back in. And I know we have quite a bit of time left, so if there are any questions, okay, I'm going to actually jump in and start grabbing some of these questions, so I apologize. And you're seeing, I'm going to stop the screen application right now. So let's just do this real quick. So you get, and again, folks, you saw the one thing that I can say about the rebalancers. It's just a great opportunity. That's a hedge fund type piece of technology there. Let's see. I'm gonna get back in here, and I apologize. Let's see. Scott's asking, one time goes on, the option prices change, so do the probabilities from the initial values. Do I agree? Yes. Scott's bringing up an excellent point. Probabilities are dynamic. In other words, when the stock price changes, time to expirations change, you'll see that the probabilities change. But I'm looking at it in terms of when I'm getting into the trade, and then after I'm into the trade, I've already lined up what my probabilities of success were at that point in time. For example, with the rig position, the probabilities actually worked real well for me, and thank you. They worked real well for me. For the cores trade, you know what? The probability of success didn't line up as well, and it's actually worse now. But since I have 35 days left of time, and I spread it off, for example, regardless of which spread you did, let's say I did the 75-90, I could roll those 90s down, which I would do right now. I would roll the untested side down. So this is a little maintenance talk. This would roll the untested side down, so I could go to the 85s. And actually, that's what I did. And you would be able to see that then I could actually manage the trade from there. And I don't know if I just lost everybody. Okay, is there any other questions? Okay, great, you can hear me. You know what, I'll bring up, let me see, I'm not. I apologize. And you know what, I don't totally solely look at, you know, just using probabilities as a way to get into the way to choose a strategy or get into a trade. I believe implied volatility is very critical as well. There's a way that I look at this as far as, you know, lining up the market. So that means looking at the charts. As a matter of fact, if I could actually bring in, I'm going to actually just, I'm going to actually bring up the platform real quick. The way that I will look at the world, and hopefully we'll be able to see this real quick. But no, it doesn't look like it's going to share. What I wanted to show you is just how the process of looking at a particular idea. So, and again, I apologize. For whatever reason, I am not able to, the projections being interrupted. No, that's okay. My bad. Okay, so what I want to do is just log into the website. Now, actually, I'm actually going to walk through kind of the concept of you know, kind of looking at the an optimal situation. And I'm going to. You know, there's a couple things that I want to. First of all, for those of you that are looking for ideas, for example, if we want to throw out a trade, let's say Apple. Apple right now, I know Vlad was talking about this before. Apple has had very bullish signals. Resistance is probably going to be, around, let's say 99.50. So we're a little bullish. And we're going to look into the September expiration cycle, and I'm looking at putting in $3,000 into a potential trade. Now, you could use our trade builder system that will actually go out and it will actually search the universe for trade ideas. And based on your expertise and your experience, you're going to see a multitude of trades. Now, you can look at them in terms of profitability, as we discussed, or probability of any profit. You can just highlight that, and what the system will do is basically line up all the trades. So, for example, in Apple Call Condor, you can see the components. You can actually bring up a risk reward graph. You can actually build the trade right here, and the biggest thing is you see the probability of any profit being lined up here. And as I said before, I always like to look at the highest probability of any profit opportunity. And, you know, it just, to me, that's where I start. If you don't have cool tools like this, how do you go in and actually set this up? Well, the first thing that I do is that you can go into charts. I use charts quite simply as an opportunity to go in and look at what's been going on with the market. So whether it's been, and you can use whatever you determine, whether it's candlesticks, bar charts, I don't care. But the bottom line is that I just look at trend. Okay, and I see for the last 6 months the stock has been moving up, and for the last couple months it's been in a pretty stubborn range. But with that being said, the bullish trend is still intact. Then I look at volatility. And I look at volatility from two lenses. One is that I can look at it in comparison to historic volatility, in other words, where the stock is trading, sometimes referred to as realized volatility. And basically, you can see that the implied volatility is much higher than the historic. At some point in time, they will converge on each other, right? When that is, we don't quite know. I can compare it to where the stock has been trading. But the point is that I look at vol and I go, okay, the 52-week low for vol is a teen for Apple, and it's right around 23 at this stage. This is telling me that basically you're seeing that the IV rank, or in other words, the implied volatility at this point at around 20, actually it's at 24.5, is roughly almost, well, it's exactly at that 50% mark. That means that the implied volatility is trading 50% higher than its 52-week low. That's telling me that there's the potential for some pretty decent sized moves. Once it gets north of 50% on that IV rank, and just quite different, taking that difference between the high and the low, that'll give you your basic IV rank. So that's telling me that there could be some volatility in here. Then I go in and I take a look at the option chains. This is where I am going to start doing a setup. Now, I don't trade weeklies and I don't trade minis. For those of you that want to, if there's a binary event you want to look at weekly strategies, that could be something. I'm going to, if for any strategy, and let's say that I was slightly bullish, and because implied vol is a little bit higher, this is where it's already starting to impact my strike selection and my strategy selection. In this case, with the stock trading at 97, I'm probably going to be looking at buying the 95s, right? And maybe selling either the hundreds or the 97.5s, okay? And I'll probably look at the 5-point spread right now. So what I can do is actually change this to vertical. I can change this to 5 points. I can change so that I can, and right here, you can see I have the September monthly. I'm looking at the 95-100 call spread, and I can click trade, or I can even go to the analyzer. Let's actually go to the analyzer and take a look at the risk reward. And you can see the risk reward. So basically, I'm risking one to make one. My break-even point is right here at 97.5. Okay. So, and with stock trading right now, it's a low barrier of entry. So if I look at this, I can actually see that the stock is trading at 97.48. So I have 35 days for this to be potentially profitable. I'm buying this for basically a parity where the market's trading. In other words, I'm getting long. So I'm buying the $95 calls for $2.50. Why am I saying that? Because basically that's what I'm paying after you take into consideration the credit you receive. I'm going to pay $2.50 for this spread. So you can put in here $2.50. And basically that means that you're trading these $95 calls at parity with the market, right? Because if you take the $2.50 you pay for the spread, you add that to your long strike, that gets you to 97.5. Folks, that means that if the market goes from, let's say in the next couple of days, because God knows that the bulls are in charge right now, but let's say in the next couple of days that Apple decides to really run up and challenge 100, because everything else is challenging all-time highs. Why shouldn't Apple? You could see the potential. Let's say in 2 to 3 days, all of a sudden this spread is now trading at $2.75 or even $3. You could actually take that off for a pretty decent profit of 10 to 20%. And I'm telling you right now, that could be an interesting but yet conservative play. I have a decent probability. It's roughly around 60, 65, right around 65% probability of being potentially successful. And that's real quick how I just pulled one out. Now I could do some further research, but I would be comfortable with this particular strategy. Now, I would struggle if I was doing something a little bit differently. Let's say if I was doing instead the 2.5 point, and let's say that I was going to do, and I'm going to look at the September monthly. So, And you can see how I can quickly do this right from the page. But let's say that I was going to do the out of the money spread, right? And here the problem that I have is that the stock is trading at 97.5. I basically need, if I pay even a $1.08 for this particular strategy, I need it to be at around 98 and right around 98.65. The probability of it being at 98.65 at this juncture is, let's see, Apple is probably less than 25%. So that to me is basically saying that I have a about a 25%, 30% probability of being potentially successful versus about a 60%, 65% probability of being successful. I'm going to take the higher probability, even though I have less capital risk in this out of the money. I'm in this to put on high probability trades. That goes for the credit strategies too. If you don't have that 70 to 75% probability of being potentially successful, why are you doing the trade? It doesn't matter how much extra premium you're doing. If you don't have that probability of success in your favor, you're gonna continue to have those mark up against you. All right. And Scott's asking, do I look at the correlation of volatility of the stock and to the volatility of the total market? Not really, Mark, or Scott, excuse me. The reason why is because the individual security is going to act much differently than the general market. What I do though, is that I look at it, the implied volatilities of the individual stocks in terms of where they are in an IV rank comparative to the general market. In other words, the benchmark. So, for example, with Apple, I would look at the Nasdaq or the Qs and see where implied volatility is for the Qs. And if IV for the Qs is low, right? And you sit there and you go, okay, well, if I got an IV rank of the Qs at 17 and I got an IV rank of Apple at 35, well, Apple's twice what the market is right now. Well, does that mean that I go and sell Apple premium? Does that mean that I get bearish? Because typically people look at high implied volatility and get bearish, which I think is a mistake. No, what it means is right now that the implied volatility in Apple is higher than it has been historically. In other words, over the last 12 months. Specifically, it's 35% higher than its lows, and with the Qs, it's only about 17% higher than where it's been over the last 52 weeks. So that's how I would utilize the correlation between broad market or total market volatility versus the individual stock. It just tells me that right now, Apple does have a higher propensity to potentially move than the general market. Whether that's up or down is not determined by implied volatility. It just means that I got to be prepared for it. All right, folks, and again, I can't say thanks enough to Tradespoon and to TradingPub for putting this on. I think this is a great opportunity to get a broad spectrum of different ideas and concepts. And it's always worthwhile to listen, and I always grab something from a presentation that I listen to. And so again, I can't say what first of all, thanks so much to the group here, and also to our partners at Tradespoon. Definitely take Vlad up. Also, for those of you that are looking for a great opportunity to check us out here at TradingBlock, there's two things that we're going to be looking to put out there for those of you that participate with TradingPub and specifically with Tradespoon. We do auto trade right now. The picks that Tradespoon and Vlad put out on a weekly basis, but we're also going to put together a rate that's going to be second to none for anybody that's coming through the Tradespoon interface. And right now you can go to tradingblock.com. That's the link. Let me try to pull off the auto trade link for you real quick, and I will send that to you. But one thing that I will tell you right now, we're going to announce this very soon, but we're going to put a rate out there that will make, well, basically the cheapest one out there, interactive brokerage, look expensive. So actually, I just put the link out there. So if you want to check out Trading Block, really you can even take a test drive. We do have virtual trade. We have other components at Trading Block that allow you to go in and test out a lot of things. We're adding new tools and advanced features in the next couple months. Right now, David's at that includes the ticket charge or minimum charge per order. Right now, we're charging $7.50 and 75 cents a contract. If I were to tell you, David, that we were thinking about wiping out the base and just doing a per contract rate, that basically would be close to, it makes people here uncomfortable. But it's basically going to be less than IB by a decent amount. So keep your eye out on that, and that's for anybody that's a registered Tradespoon user. We appreciate them being partners of ours, and we also appreciate you for bringing your business. So please check us out at tradingblock.com. Scott's asking, aren't you giving up high probability for a lower profit? The end result is the same over the long term using the strategy of a lower probability and higher profit. Do you agree? Not necessarily, Scott, especially not in environments like we're in right now. With low implied volatility environments, I want to take the higher probability, lower profit. When vol does expand, I would agree with you that you could take a little bit more, in other words, a little bit more risk. In other words, taking a lower profit for a potential higher probability. But at this juncture right now, taking a higher probability for a lower profit, it's just not paying in a low implied volatility market. Two reasons why. One is that you're not getting paid enough to take on that risk, especially for those of you that have been doing credit spreads or credit strategies. It's been brutal for the last month and a half, really the last couple months or more, but it's really been tough the last month, and the last couple of weeks it's just basically put everybody over the edge. So for me right now, what I do is I look at it and say, I would rather have a lower, a higher to mid-range probability for a lower risk. It just basically works for me in this environment. Now, David's bringing, as long as you're going to compete with small orders, 1 to 2 contracts, that I'm very interested. David, that's the whole point. We're trying to put a rate out there that basically, is going to definitely put you in the range where you're going to average a commission cost. It's going to be, we're talking about a per contract and wiping out a base, or the base will be, yeah. So I don't want to give it up right now because I can't. But the point being is that you'll be able to execute at a rate that's going to blow everybody away. And Scott, again, when I look at probability, it's not the only. Are we offering it internationally? David, if you're in the UK or Australia, yes, we're working on expanding. But right now, the UK and Australia. Oh man, let me guess, you're from Canada. No? Okay. Well, tell me where you are, and then we'll see what we can do. It takes time, though. So it seems to me that you're looking at the fact that market volatility is at historic lows. Is that correct? Yeah, I mean, this is brutal. I'm looking at implied volatility at lows that, not historic lows. I mean, I remember when it was at 8 and 9, but if you put it in context of, first of all, how low it is right now comparative to where we are in the market, in other words, all-time highs. And by the way, we're making all-time highs today on half the average volume. I mean, to me, that just is crazy. Now, I'm not fighting it, but as a former market maker, and yes, I tend to be more of a premium seller than a buyer at times. This is mind-boggling. But as mind-boggling it is, using things like probability, using that statistical analysis of standard deviations helps me stay out of the way of placing bad trades. And yeah, everyone, please send me an email at support@tradingblock.com or support@moneyblock.com. Support@moneyblock.com or support@tradingblock.com. And that will go directly to me. And I will answer any of your questions. And again, I know that we're coming up on time right now. I think we have like 30 seconds left. And thank you, Yana. You have been incredible. Again, I want to thank TradingPub. I want to thank Morgan, Yana, Raleigh, the whole clan group there for having us on. We look forward to doing future events with you. And if you have any questions pertaining to Tradespoon, info@tradespoon.com, that goes directly to Vlad. So with that being said, I want to thanks everybody. Hey, get ready for some fun stuff that's coming up for the rest of today's presentations. And I can't thank you enough.